Hello everyone, welcome to EPK Capital. Here we simplify wealth management and investments so you can build wealth for generations. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's get started now. If you are a non-resident Indian holding wealth in India, specifically real estate or a significant portfolio, you are living in a dual reality. On one side, you have the incredible growth story of the Indian economy. On the other, you have a system designed to ring-fence your capital before it ever leaves the country. Most investors think of TDS, tax deducted at source, as just a compliance step, a pay-as-you-go tax. But for the NRI, TDS is often a preliminary confiscation of liquidity. Here is the scenario. You sell a property for 10 Indian rupees crores. You might have actually made a loss on that property or a very small profit. But the buyer? They don't know that. To protect themselves, they might withhold nearly 24% of the entire sale price. Not your profit, the sale price. That is 2.4 Indian rupees crores of your capital locked away for up to 2 years. Today, we are breaking down the sovereign NRI dossier. We are going to cover the massive changes from the 2024 and 2025 Finance Acts, the new grandfathering rules for property, and the specific legal protocols, like the Lower Deduction Certificate, that can save you millions in trapped capital. Let's get your liquidity back. First, we need to define who you are. You might have a foreign passport or an OCI card, but the Indian Income Tax Department doesn't care about your travel documents. They care about a mathematical calculation of your physical presence. For years, the golden rule was 182 days. If you stayed in India for less than that, you were an NRI. Safe. But recently, the net has tightened. If your Indian taxable income exceeds 15 Indian rupees lakhs, and be careful, one property sale or large dividend can trigger this. Your safe harbor drops to just 120 days. If you stay 121 days and you hit that income threshold, you might be classified as resident but not ordinarily resident. Why does this matter? Because if you lose your pure NRI status, your tax-exempt NRI and FCNR accounts are technically no longer valid. You might have to convert them to resident accounts, losing that tax-free interest shield. Key takeaway: count your days. If you are planning a 5-month vacation in India the same year you sell a big asset, you are walking into a compliance trap. Now, let's talk about the biggest asset class in your portfolio: real estate. The ground shifted beneath our feet in July 2024. Historically, we had indexation. This allowed us to adjust our purchase price for inflation, drastically lowering the tax. The government proposed removing this and replacing it with a flat 12.5% tax rate. After a lot of pushback, they introduced a grandfathering clause for properties bought before July 23, 2024. You now have a choice: pay 12.5% tax without indexation, or pay 20% tax with indexation. You have to run the math. If your property value has exploded, the 12.5% flat rate is likely better. If your property grew slowly, barely beating inflation, the 20% rate with indexation will save you money. But here is the gross value trap. Even if your actual tax liability is low, the buyer is terrified of the tax department. If they fail to deduct the right amount, they can face jail time. So, they won't listen to your math. They will default to deducting 20% plus surcharge on the total sale value. On a 5 Indian rupees crore sale, that's a 1.2 Indian rupees crore deduction, even if your tax bill is only 28 Indian rupees lakhs. The Indian growth story is exciting, but the regulatory friction is real. Wealth preservation for the sovereign NRI isn't about evading taxes. It's about not paying a rupee more or a day earlier than the law demands. By using strategies like lower deduction certificates and understanding these changes, you can increase your effective yield by 15 to 20%. If you are looking to sell a property or restructure your Indian portfolio this year, do not rely on the buyer to calculate your taxes. Next step, check your PAN status immediately. If it's not linked to your NRI status properly, it might be an operative blocking all your refunds. Thanks for watching. Subscribe for more strategic dossiers on cross-border wealth. This is not financial advice. Consult a professional.